Thank you for making time out today to discuss around an important but less understood topic, behavioral biases in investing. Joining us today is our Managing Director and founder of Opportune Wealth, Ms. Suruchi Jain. She worked at Morningstar as an equity research analyst before starting Opportune. She used to appear TV channels, CNBC, TV 18, monitor control for her stock reviews at US-based venture capital company during her MBA. Her meeting with Buffett made her change her field of work from venture capital to public equities. With this, I'll hand over to Suruchi ma'am. Over to you, ma'am.
Great. Thank you so much for the intro. I hope everyone can see my screen. Yeah. Anuja, you can see my screen, right?
Yeah, I can see the screen. Yes.
Okay, great. Thank you all for joining and for making the time. With that, I will begin. So the topic today is how to avoid biases in investing. I'm Suruchi Jain, Managing Director and Founder at Opportune Wealth. And as Anuja already mentioned, my meeting with Buffett is what made me go into the public equities path. And with the sole aim of helping people find a way to make money while they sleep, right? So that they can retire early and they can experience the compounding of wealth through equity investing. So with that, we jump into the topic. I start with a quote. What Benjamin Graham, who was a famous investor and the mentor of Warren Buffett, said is that the investor's chief problem and even his worst enemy is likely to be himself. We'll understand through this presentation why he said that. Sorry, just a sec. There's some issue with the scrolling. Yeah. So as we can see, markets are driven by emotions. In our current scenario, markets are down quite a bit. And we'll explain why that happens. Usually markets go up quite a bit and then they crash quite heavily as well. Markets are essentially volatile. And that's not because of company fundamentals. It's due to irrational human behavior and extreme emotions. The cartoon below just shows you, when things are down, people say it's time to buy. Oh, it's in the papers, it must be right. And then suddenly the emotions just swing the other way. The end is nigh. We're facing an abyss. Why is everyone panicking? It must be bad. So now it's time to sell. In this day and age, we spend over 5 to 6 hours on average on our mobile devices and even in front of our computer screens. We are currently also right in front of our computer screens as we attend this webinar. There is an information overload. The amount of influence that digital media has on our thought and our thought processes and our decisions is massive, and it's on the rise. What this leads us to do is make certain pitfalls like borrowed conviction on stock ideas and panic selling or herd behavior. We'll tell you the 5 most common behavioral biases. So these are the 5 biases that we will be evaluating this afternoon. First is loss aversion. Second is anchoring. Third is recency bias. Fourth is herd mentality. And fifth is confirmation bias. So let's jump right into loss aversion, which is the first one we are evaluating. Essentially what we're saying is if you lose money, it is twice as painful as the pleasure of making a gain. What do we mean by that? Essentially, if you think about it, when people are, say something bad to, another person, you'll always kind of remember what they said, right? What is it that they basically bad thing that they said? But any of the good things that someone says, it's very hard to remember. So all the bad, that's just the way of the cognitive mind. The human mind is such that it sticks to bad news and it sticks to bad information. Similarly, this hampers our investing. So if you've made a 10 rupee loss right? It will hurt you twice as bad as if you make a 10 rupee gain. Just a very simple example. So it's not an even scale, even though the amount is the same, but cognitively, it will pain you much more. Let's take the example. How does this work out in our portfolios, right? The common mistakes that we make. So for example, just assume that this is your portfolio, right? You have 4 companies, company ABC Co, XYZ Co, TXV Co, and FVC Co. You have already made 30% returns and 10% return in the top 2. And in the bottom 2, you're down 10% and 20%. So what typically people do is that I've made a good return on these 2 stocks. So let me sell those 2 stocks and capture the gains, right? Whereas in TXV and FVC, oh, I'm making a loss here. Why don't I stay invested so that over time, these stocks will come back to a certain level and then I will sell it. So what do? They hold on to the loss-making ones and they sell the profitable ones. But that's actually the wrong thing to do. What they're actually doing is they're cutting the flowers and watering the weeds. Instead, what should you do? What's the right action? You should actually be watering the flowers and cutting the weeds. So the correct action is actually to keep ABC Co and XYZ Co and sell the loss making. So it's actually the reverse. You should hold on to the top 2 and you should actually sell the bottom 2. That is the correct action. How can an advisor like us help in such a situation? I'm giving you a real example here. Please note, these are real examples that have happened in our portfolio. They are not stocks that we are recommending at this point in time. So that's a really clear disclaimer. I'll go over it at the end as well. But since we've been in this market for more than 6 years and helping clients invest, we've been able to help them overcome some of these biases. And this is how we do it. So for example, Delta Corp, right? We had bought it around 250 rupees, right? And we entered it for the first time and we could see that it's falling. What we did was we exited, right? We realized, okay, it's not always that the price is in line with the fundamentals, but here we felt like, okay, maybe we made the wrong decision. There's an opportunity cost involved if we continue to hold something which is not doing well. Why don't we instead take out that money and put it into something that will do better? So that's what we did. We took a loss, even though it was painful. So cognitively, if the Delta Corp company was in your portfolio and it was making a loss, the natural human tendency is for us to keep on holding it, right? And then someone might say, oh, but you exited in a loss, 160, 170. See, you could have gone to 200 rupees and then you could have exited. But the time horizon here, right, is almost like 6 months. And in 6 months, you could have already found another company and invested in something else. Yeah, there is obviously a reinvestment risk. But we as an advisor, we try to overcome these cognitive failures. So what we do, we take a loss and find the next flower, cut the weed and find the next flower to water. Going to the next one, which is anchoring. So anchoring is basically, I'll show you, it's any prior data point which becomes the anchor or the basis of a starting point for a conversation or for evaluation. Have you ever been in a salary negotiation? So if you're in a salary negotiation as an employee and the employer, and whoever says the number first, right, that kind of becomes the anchor. That becomes the basis of the start of a negotiation. So that's again an anchoring in real life. Let's take another example. You've been to discounts, I'm sure there's sales going on right now, right? This is like the monsoon sales are going on right now. So discounts is actually a trick against the human rationale. They never tell you that some product is actually worth 300 rupees. No, that would not make you buy it. Instead, what do? They mark it up to 1,000 rupees. And then they say, oh, it's now available for 300 rupees. So they make you think like, oh, you're saving 700 rupees. But they're not saying that you're actually spending 300. So you end up paying 300 thinking that you saved 700. That is what anchoring does. Here, your mind is anchored to the 1,000 rupees and not to the 300 rupees that you're spending. So you feel good about it, right? You're saving money. You feel good about it. How does this reflect in our portfolio? So in our portfolio, taking the same 4 companies as an example, right? ABC Co, XYZ, TXV, and FPC. What our prior price or purchase price was 100 rupees, for example, right? And the new price, current price is 130, 150, 80, and 70. So what do we do in this situation? The wrong action, and which is the most common example and the common action people take, is they avoid, right? If something's gone up a lot from 100 to 130 or 100 to 150, we likely try to avoid that. Okay, it's gone up too much, we shouldn't buy it. Whereas if something's gone down, it's gone to 80 or 70, people end up buying. So this is a similar example of what we taken the last time, but that is the cognitive bias. We feel it has already gone up so much, we shouldn't be buying it, and this is cheaper now. But can I give you one simple example of why it's not a good idea, right? So when I see TXV and FBC have gone cheaper, right? What is cheap in this world? Trash. Trash is cheap, right? So essentially, if you keep buying things that are cheap, it's the cigar butt theory that even Benjamin Graham had. And Buffett used to use it initially. And he realized that that's the wrong way to pick companies. That being cheap is not the way to buy companies. You know, it's quality companies that you want to buy. So trash is always cheap, right? Your Raddi wala takes 1 kilo Raddi for 10 rupees. That price hasn't even changed in so many years. But what about jewelry? Jewelry is always expensive. So do we want jewels in our portfolio, or do we want some trash in our portfolio? And that's what you have to decide. How do we as an advisor help? This is again a real example. We had Bata in our portfolio, and we had it in early 2019. We entered the stock at say 1300 rupees or so, and we saw it go up quite a bit, you know, all the way to 1800, 1900. And then the pandemic hit, right? And the pandemic hit and it crashed to quite a bit. It crashed below our original purchase price. And people felt like, okay, schools are shut, no one's buying anything, no one's going out to shop. And we felt like, okay, it's a good company, let's stick around. But at some point, we realized that, okay, it's not moving as much as some other companies. It's not doing as well. We have more opportunities, right, to buy good companies which are available for less value. And so instead of anchoring at this price, saying that let's wait for it to come back to that price, which it was earlier, the 1800, 1900, we exited the stock, right? And then we found better companies to invest in. So not every investment will become a winner, right? Don't anchor to a prior high price and exit at the right time. Okay. So that's our second behavioral bias. Let's go to our third behavioral bias, which is recency bias. So recency bias has to again do with the human tendency to overweigh the most recent information that has come to mind, right? Give you a simple live example. Supposing someone you know who's been in very good standing and is a very good citizen, he does something wrong, right? And then that always sticks in your mind that, okay, no, he's not such a good citizen as I thought he was, because he did that one thing which was wrong and which was very recent. So how do we apply this in the investing world? So, you know, mutual funds always publish their average 5-year returns. They're publicly available on all platforms and in several newspapers as well. They also publish their average past 12-month returns. So 12 months is a shorter time horizon. It's a more recent time horizon. So even though the 5-year average returns are looking great, what do investors usually do? When the 1-year return is really bad, the first question that comes to their mind is, should I continue investing? Should I continue holding? So I got a lot of these questions as soon as the pandemic hit, right? And my obvious question was, look at the 5-year returns. Look at the 5-year returns and stay invested. But the natural tendency is that, oh, it's done so badly, we shouldn't stay invested. So again, we have to trick our mind when we are looking at investing and making better decisions in investing. The most recent information sort of circles in our mind, right? It just keeps going round and round and round. It keeps bothering us. I'll give you an example. You know, like the chakki ka atta, which is there, the chakki which is there, which pisos the atta in the villages. The information sort of keeps going around that in our head, right? How it is, it's basically a chakki in the middle, and the ox is tied to the post, and the ox keeps going around and around. And the more round it goes, the atta keeps getting pisoed, right? So that's the image I've shared here. I'm hoping with these images and real examples, it really sticks in your mind that these are things you should be avoiding as you invest. Same way, you know, it's like a maze. Information just keeps circling in our mind and we take the wrong decisions because of recent information. How do we as Opportune internally have a process to avoid these biases? And how do we try to help our investors take the right decisions? What we do is we give them an expert point of view, and giving them a perspective is important. How do we do this? We do a monthly newsletter where we write, you know, what we think is the right thing to do in any market environment. So even recently we mentioned, you know, markets will correct because of interest rates going up. But this is the time to stay invested and buy more if you can. Well, what did we do in the past? In March 2020, we mentioned in our same newsletter that this won't last forever, and that this year you will see maximum gains. So keep investing. There are a few clients who came to us who came in with a large portfolio just in March 2020. They had the confidence and they've done really well. Similarly, a year later in Jan 2021, right, we mentioned that this won't continue forever. So the good returns are not everlasting. And in 2021, you may see the correction and you might see negative returns even in 2021. And so you should invest with caution. So having someone to buy your side, like an advisor or a portfolio manager, really helps you avoid these biases, which a lot of people end up doing when they're managing their own investment portfolios. Let me come to a fourth, and this is a really interesting one. It's a herd mentality. So humans find comfort in following the crowd, just as sheep do. Yeah, it might surprise you, but that's the truth. So what this image shows you is just a sheep, right? So sheep and cattle, when they see that there is a danger on one side, they just run in the opposite direction. So here they're not seeing that, okay, it's a cliff and they're about to fall off a cliff, but they just keep following. When they see other sheep jumping, they also continue to jump without really thinking, right? So what does this cartoon say? I don't know where we're going, but from the look of it, it must be really good, right? So they're not thinking for themselves. When does this happen? So this is the most, I would say, one of the most important biases. And this is what causes market overreaction on the upside and on the downside, right? So when markets are moving, it happens that, okay, it says, okay, everyone says, let me wait and watch, right? And so markets are still continuing to go up. And then they feel, okay, I can't wait any longer. Let me just buy at this price. And then when it goes up a little more, you say, okay, glad I didn't wait, you know, and then you bought. And then when it starts going down, oh, I will use this correction to buy more. But then it continues to go down, right? You already bought at the peak. Oh, okay, maybe it will not go down. What did I say? It will correct. I mean, it will only be a minor correction, but it continues to correct. And then you lose patience. Enough is enough. You know, it's time to sell, but you still hope. And then you sell. And then you feel like, okay, lucky I got out in time. Phew. And you sell out some more, not realizing that this is the bottom and it's actually the time to buy. And this is because everyone around you, like the current scenario, everyone around you is really, really, pessimistic, and nobody believes that markets will do well. And then when it starts going up, you're like, oh no, wait, what's happening? And then by the time it's recovered again, you know, to your original buy price, you're like, oh no, I knew it would recover. I don't know why, damn it. Why did I listen to the herd behavior? So this is the most common thing that happens. And this is why market overreacts, right? On the upside and on the downside. So the way to avoid herd mentality. is to wait a minute, something feels wrong, and think for yourself, right? That, okay, this is not the right thing to do. I don't think I want to jump off a cliff. Let me not follow the other sheep, and let me just wait here and think for myself. So how does this play out? I already showed you how it plays out in the markets. But how does it play out in the real world as well, right? Traders, right? Traders usually sit together. So if you have an account at any of these trading companies, all the traders are sitting together. And unfortunately, the traders sitting together further exacerbates prices going up or down. So if someone gets a large order from a client saying, okay, buy this stock, then they just transfer that information to everyone, and everyone kind of starts buying that stock. Or if it's a negative news on a particular stock, then everyone just has a negative news and the stock just collapses. So same thing happens within the broader markets, not just stock specific. So traders sitting together actually further exacerbate herd mentality. How do you avoid this? Advisors usually sit alone with you. They try and figure out your financial goals. They work with you on how to avoid these biases and work on a long-term plan, right? Should also think that, okay, traders sit together, they're investing, they are more interested in you transacting every time. Every time you transact, they get a 0.2% brokerage, right? But advisors, they are getting a percentage AUM fee. So they get paid when your portfolio grows. So they are completely aligned. So I would say choose your advisor wisely, whether it's a trader or it's an investment advisor who is aligned to your interests, long-term interests. I'll take the last bias, and then we'll share some more information about how we go about investing and avoiding these biases and what we have coming up. So confirmation bias is the last one we are talking about. We accept information that confirms your previous beliefs, right, or biases more easily than new information. So again, what this image is trying to show is that this person in orange is trying to share some facts with this other person. And this other person already has a set belief in their mind. So they're just constantly, rejecting what they're saying. For example, let's take an example, right? This person believes that a company is really good and they'll do really well in, say 5 to 6 years. But the fact that this person is sharing is that, hey, profits were down 20%. Oh, don't worry, it's just a 1-year scenario, is what the other one says. Oh, but last quarter, they again didn't get good revenues. So he's just kind of dismissing all the facts that come to him because we have this confirmation bias, right? So what happens when there's objective facts being thrown at you? What you see is just facts that are confirming your beliefs. Everything else, our human mind has a tendency to reject. So that's the unfortunate part of, our cognitive biases. And how does this play out in our portfolios? When someone is working in a particular sector, say you're a tech person, right? An IT services person, then you feel like, okay, I don't understand anything beyond this sector. So it will lead to overweighting the stocks or sector in your portfolio, say information technology, right? And how to mitigate this risk is to seek contrary advice and avoid confirming questions. So it's very hard to get out of this, but you should always try to seek contrary advice and avoid confirmation questions. In summary, these are the 5 biases. Loss aversion, where a loss is double as painful as a gain of the same amount. Anchoring, where you end up anchoring a prior information or a prior price, and you're not using the current price as a judgment of what the value of a stock should be. Recency bias, where the most recent information circles in your mind and helps you makes you make the wrong decision. Herd mentality, where you tend to follow the crowd. And confirmation bias, where you have a very hard time changing your beliefs despite the facts being in the opposite direction. So how can an advisor help? Having a diverse research team can help eliminate biases. So we are Opportune Wealth. We have, Shivam, Prem from very different backgrounds and a very different mindset. So how we go about it, we come up with the thesis for our research. We come up with what is the hypothesis, and we keep testing it to avoid confirmation biases. And we challenge each other on our decisions, and we challenge each other on our research to make better decisions. What we also do is we track the market news daily, whereas prices we are tracking on a weekly basis. This is basically just to avoid that, again, bias. So news and fundamentals are important to follow, and prices are tracked weekly. We also review our forecasts and models on a monthly basis, and we listen to company management on a quarterly basis and revise our thesis and then take action. What we advise to avoid these biases is to get to know yourself better, right? So become more aware about how your tendencies influence your financial decisions and try to avoid these decisions. Stay focused on your long-term financial goal. So while investing, you should focus more on the bigger picture rather than predict what may happen in the next quarter. And avoid panic selling is the third way. So stay invested during bad times, which is times like this. Quick overview of Opportune Wealth. We help you do equity investments, which are research driven and selection of stocks, mutual fund advisory, which is again research driven selection of mutual funds. And we also help you do financial coaching, which is behavior and goal based planning. That's our research methodology. How we go about selecting our companies is through select industries, within that winning companies, sound management, and fair valuations. Just to share with you what our results have been so far. And this is as of March 2022. So in 5 years, we have managed to do a 17% CAGR return. In 4 years, 18%. And all of these are post expenses. And 3 years is 23%. And you can see all of them are outperformance. In 2 years, 50%. And a 1 year, 27%. So this is, you can see the time period between March 2017 and 2022 is when we did 17%. And the last 1 year, we've done the 27%. I want to also share with you our latest portfolio. So we've just come up with a new theme. It's called the home improvement portfolio. And we believe home improvement is a very good area where essentially post-COVID, people want the comforts of their home being really pretty and very comfortable as well. People don't mind spending on improving their homes with better furniture, better accessories, better consumer durables. And even the painting cycle has shortened. People are painting their houses more often. They want to make them look presentable. So we've come up with this theme, which has a mix of all these sectors: paints and interiors, adhesives and repairs, plywood and laminates, sanitary or bathware, and consumer durables, pipes and tubes. So if you'd be interested, we're happy to walk you through that in more detail. Essentially, how have we gone about choosing this portfolio? We have looked at the financials and the quality of earnings. So we've categorized companies based on their growth, margins, return ratios. Liquidity, we've seen that there should be enough liquidity on average daily volume criteria of a minimum of, say, 10 crores. And the business, we want to be able to understand the business. So we have shortlisted companies where we understand the business, where the opportunity size is large and the growth potential is also high. So putting all these companies into a bucket, we've chosen about 10 to 15 stocks in our portfolio. And essentially, why have we chosen these sectors? It's because the industry that is there in 2020, we expect that each of those, the opportunity size is 2.5 to 3 times over the next decade. So we see this as a huge growth trend. And we think choosing the right industry is one of the main ways how you can make money in the long run. So with that, I come to a close. with a quote. Investing isn't about beating others at their game. It's about controlling yourself at your game. That's by Jason Zweig, a renowned personal finance journalist. And a quick look at the disclaimers. All the stocks we mentioned, we're not recommending any of those stocks. Please reach out to us independently to evaluate what would be good for your portfolio. That's my email, suruchi@opportunewealth.com. And please do visit our website, www.opportunewealth.com. If you have any questions, I'm happy to take those questions now. And feel free to reach out to us as well. We will also do a short quiz if we have time for that. And you can win some merchandise. So we'll just take a few questions right now. I think Pushparaj is asking us that home improvement theme, is that available in small case? No, it's not available on the small case platform yet. And we're still deciding whether we want to put it there. What we have so far kept is a minimum of 10 lakhs for existing clients and 20 lakhs for any new clients who would like to come to us directly as an advisory setup. So we'd be happy to discuss that further with you. Currently, it is not on small case. Any questions? Any other questions? I'm just going to take this opportunity to, take a small quiz. For those of you who would answer, you can answer on the chat. And whoever gets, the maximum right answers, we can, give you some merchandise. Yeah, Meera, you had a question. You want to type it out? Or let me just unmute you. Give me 1 second. Yes, Meera, you can speak. You're able to unmute yourself. Okay. No, I don't think Meera has a question. Give me 1 second. I'm just going to take you to the 3 questions. Okay, so if you'd like to win some merchandise, here's a chance. So there are 3 questions about Opportune Wealth, and if you answer them correctly, then you will get some cool merchandise. You just have to share your name and address with us, and we'll send it to you. So, which year did Opportune start operations? Fingers on your keypad. Please send it to us. Which year did Opportune start operations? No, wrong answer. Only one chance. Okay, yes, someone's getting the correct answer. Who else? Okay, cool. So 2 people got the correct answer. Anyone else? Yes, 2016 it is, correct. So it's 2016. Which year did Opportune start operations? We started in 2016. And some of you would remember, we just celebrated our 6 years. So 2016 is when we started. So what is the primary service offered by Opportune? Is it advisory, distribution, financial planning? I'm giving you options here. Okay, just says advisory. Anyone else? Karuna, Pushparaj, Rajesh, anyone? Okay, correct. Advisory it is. Advisory it is. Okay, and this is a third question. Fastest fingers first, right, will win the merchandise. Who is Opportune's primary partner broker? Who is partner broker? Okay, Jess got it right. I was about to give options, but I guess for the others, let me give you some options. Okay, 2 people have got it right. So yeah, it is Motilal Oswal Financial Services. So that's correct. So I think, Pushparaj, I wish you'd answered the first question. Then I would be able to send you also some cool merchandise. You didn't participate in the first answer. But yeah, okay. So please send us, we have Jess and Mira's addresses, but for participation, we will also send Pushparaj, a little something. So if you can just put your address in the chat, Pushparaj, we will send you a little something, for being a sport and answering 2 out of 3 questions. Great. With that, we come to the end of our session. Thank you so much for joining. If you have questions, please feel to write to me, and we are available, offline as well. And Pushparaj, since we don't have your email, please, share your email and we can, send you the merchandise. Great. Thank you so much. And with that, we come to a close. Thank you for joining the session. Yeah, Pushparaj, we've got your email ID, so we will just email you and get your details. Thank you.